Hey, this is Greg. Welcome to the channel. On this channel, we talk about markets and investments, and the purpose of the channel is to make you a better investor. Okay? Now, last week, Paul Tudor Jones, who is a world-famous hedge fund manager and sort of, all-round master of the universe, had a very, very interesting interview with CNBC wherein he talked about some very specific and very important inflation news that came out the day before, namely that CPI was up 5%. And when you back out food and fuel, for those people who don't drive, eat, or heat their house, it went up 3.5%. Now that number was the highest inflation number in 28 years. And that was the subject of the interview. Okay? So what I want to do is I want to play you the interview, and then I want to make a couple of comments. But in case you don't know who Paul Tudor Jones is, he is a very famous hedge fund manager. He's been in the business for many, many years. He's very well known. He manages about $7.8 billion in his company, which is Tudor Investment Corporation. He's one of the guys that I follow, along with Stanley Druckenmiller and some of the other people that I've featured on this channel. So let's take a look at the interview, and then I'll come back with a few comments.
Okay, so here's the real question.
Right.
If things are bad as crazy right now, and you are a trader, not necessarily even a long-term investor, but a trader, let's just say you're thinking about where to put your money. I'd actually love to hear about it in the context of being a trader, but also actually as a long-term investor. What are you supposed to do in this environment?
Well, I'm going to watch the Fed on Wednesday. If they treat these numbers, which were material events, they're very material. If they treat them with nonchalance, then I think it's just a green light to bet heavily on every inflation trade. The idea that inflation is transitory, to me, is that one just doesn't work the way I see the world. So I look at $88 trillion of assets under management by asset managers. Of that, $670 billion are invested in commodity indices like Bloomberg Commodity Index, Goldman Sachs Commodity Index. That's about 0.75%. If I rewind just to 2011, when inflation was peaking at 3%, not CPI at 4.9, those same investors had 1.2% of their assets, which would imply today, if they just got back to weight, another $400 billion of buying in commodity indices. And if you, certainly the impact models that we run would argue that 𝐥𝐤𝐬 or 𝐵 would double or triple. So you've got, if I just look at where asset managers are, 60-40 types, the one thing that they should be invested in, they're not invested in, probably because they're hearing these assurances that inflation's transitory. So you've got this massive short, really, in the commodity complex, a massive short there. So that makes me think that, and I look at the balances in a variety of commodities, and they're all so razor thin. They're all so razor thin. And this is just what happens if institutional money would get to where they should be, given the level of real rates. What happens if the Reddit crowd ever gets into commodities? God forbid if the bullies, the financial markets, ever were to take it on, for instance, like retail did back in the 70s.
Explain what you mean by that.
What I mean is that commodities are finite supply, small markets, generally speaking. And if we ever get an inflationary psychology, like, for instance, we did when I was in my 20s, back in the 70s, if we ever get that again, and if you ever got retail actually nervous about inflation, then the one thing that leads inflation, which is commodity prices, it's the easiest tautology there is. those things can literally screen double or triple with no problem whatsoever.
So you're worried about the Reddit crowd getting involved in commodities right now?
No, I'm saying that right now, I would be a lot. Look, I think I'm the most conservative investor in the world. That's a hedge fund manager by definition hates risk, loves edges, loves competitive edges, does great reward risk trades. I would be really concerned about arguing that inflation's transitory when I know that you've got. Look, think about it. We have a just-in-time mentality. We have inventories at record low. We have demand screaming, and we have people who are really underinvested where they should be, given the valuations of a variety of financial assets.
You said if the Fed doesn't make any moves this week, that it's going to be a green light.
Well, for me, it would be a green light.
But the question is, so it may be a green light temporarily, but you're also suggesting that there's going to be a hard stop at some point, that it's going to create an even bigger problem. And so how does a long-term investor think about that?
Listen, I have maintained, I'm so happy I don't have to run a pension fund. I don't know how you'd invest those assets when valuations for both interest rates and stocks are at, if you combine the two, they're so overvalued. They're at 100-year highs. I don't know what you do. I know one thing I'd want to do is the one thing that can hurt that is inflation. I'd have as many inflation hedges on as I possibly could. I sit on, the investment committee of these not-for-profits, and it's really difficult to try to explain to some of the board members of our not-for-profits, gee, maybe now's not the best time to be invested in a variety of finance. Maybe we should own commodities at this stage of the game. Right. Can I just say one last thing? The December 2018 meeting, if you think about that meeting that the Fed had with pretty much the same board makeup, they had a lot of incoming data between that meeting and the one prior to that. The stock market was down 12%. GSCI was down. Commodities were down 20%. The credit markets were frozen. But they went on and hiked because they were locked in to this linear belief that I can have a forecast and that we should stay with it. That predictability was more important than reactivity. So I think they had the same, and 7 months later, they had to reverse course and take that back. I think we're confronted with exactly the same situation right now.
Okay, so that was interesting. And so from where I sit, there's a couple takeaways that you can get from this interview, which are very important. Okay, first, since the Fed reacted so minimally to what I perceive and also he perceived as very, very material inflation numbers, at best they're thinking about tapering, much less raising interest rates. I think they said they won't even consider raising interest rates until 2023. So all they're talking about is really thinking about something, which is really, it basically equates to they basically did nothing or are going to do nothing, at least in the near term. Okay, this is very significant. I think we can all agree that these latest inflation numbers are material, and I have expressed on this channel many, many times that I do not think that inflation is transitory, and once it takes hold in the industrial complex, in consumers' minds, and in the commodity complex, it is very, very difficult to unwind. Another point he made was when you look at classic asset allocators like pension funds that typically go 60% into equities and 40% into bonds or something like that, what he was saying essentially is that they are massively under-allocated in commodities right now. And if the institutional investors were merely to balance out their portfolio allocations to an appropriate allocation to commodities given the increase in inflation, you could see just by doing that a tremendous increase in commodity prices. he referred in the interview as there's a massive, in effect, a massive commodity short. And I think what he meant by that was simply that the institutional investors out there are massively under allocating at this point in time to commodities. The other point he made is that if the inflation psychology were to permeate the retail investor, you, along with this reallocation of institutional investors, you could easily see commodities double or triple almost overnight. And that's because many of these are smaller markets, they're more thinly traded, et cetera, et cetera. And I will remind everybody here, if you've been following the channel, that I have been preaching, so to speak, investing in the integrated oil companies because I believe oil and gas are two commodities that are not only a great inflation hedge, but also as the commodities go up, you're going to see continued increases in the energy sector. The other point he made is that in the manufacturing space, we have been using for many years this just-in-time inventory approach, which makes inventory management more efficient. Because of that, you're seeing supply disruptions, and that puts additional pressure on commodities all the way up the supply chain. And we've talked about that quite extensively on this channel also in the past. And then finally, he mentioned that along with all of these other dynamics, the stock and bond market are at, 100-year highs right now. And many people on Wall Street, I believe, are still being lulled into this false sense of security by the Fed's assurances that inflation will be transitory. And with the government now talking about another potentially $2 trillion pumping potentially $2 trillion into the system, which of course will be monetized by the Fed and its continued money printing. Remember, 120 billion a month, which is an enormous amount of money. There just seems to be no end in sight for this insane and reckless spending that's going on in Washington, and there seems to be no end to it. So anyway, that's it for today. If you got value out of this, please like, subscribe, and hit that bell so that you get noticed when I come out with more videos. And I generally come out with at least 2 videos a week talking about investments and markets and how to make you a better investor. So I hope that you subscribe so you can be on board for future presentations, which will be coming your way very soon.